Now, for more on the global financial outlook, let's bring in Jonathan Morris. He's an adjunct professor at Georgetown University who specializes in corporate finance and capital markets. Welcome back to the show.
Thank you, Rachelle.
So as we look at this report, what was your overall assessment?
Positive, globally positive. The IMF increased their numbers from their April report. The global numbers are 3.6 across the board for 2017 and 3.7 for 2018.
So certainly a lot of positive there. Any sort of tempered expectations that you saw in there?
Well, there's a concern that there's a little transparency in terms of what will happen with U.S. regulations. And the U.S. numbers are actually flat from April. They're 2.2 growth rate for 2017 and 2.3 projected for 2018, not taking into account any tax cuts. And the IMF is waiting to see what will happen with respect to tax legislation, as many of us are as well.
Now, how would you say the overall picture has changed for better or worse since the last report?
On a positive note, international trade is way up. Consumer confidence happens to be way up. There seems to be a feel-good relationship between a lot of different countries, aside from what we may hear on the news on a regular basis domestically. Trade seems to be quite fluid. So that's a very positive aspect of what's happening today.
And any sort of negative headwinds that you've seen since the last report?
The slight negative is that the IMF is concerned about central banks making sure that banks and insurance companies are well reserved. And that is their number one advice in terms of mediating any future rumblings in this positive growth trajectory. So they've given that a shout out saying, let's focus on making sure our financial institutions are tight in this time of positive growth.
Now, let's also look at some of the risks that they saw from banks. They said that they were rotating now to financial markets. What sort of issues does that bring?
Well, many of the banks, central banks, have retained very low interest rates. Now, the U.S. has begun ticking up interest rates. But what you have with more globally low interest rates is investors seeking higher yield. And when they seek higher yield, inherently, they incur higher risk. And it's that risk that is concerning to the IMF. Do investors recognize the risk that they're taking while they're seeking higher rates of return in their investments? So that's a concern that they voiced very loudly as well.
And how much of an impact do you think that would have on financial stability?
Well, at the moment, my personal opinion is not a lot. The financial markets have grown so large, and there are alternatives out there that do create higher yields than what the banks allow. Not all of those are high-risk investments, but they provide 100 or 200 basis points above, which is above a bank's rate. The bank's rate, as you well know, is quite nominal, right. Well under half a point. So if you can get 1% or 1.5% or 2%, you're doing quite well relative to what you might get in a typical bank.
Now, the IMF did make some recommendations for policymakers and regulators to really try and fend off some of these vulnerabilities. How realistic are they?
Oh, I think they're very realistic. They're not that difficult to implement. One of the number one recommendations is to have central banks communicate what they're planning to do with their portfolio, what they're planning to do with their strategy, instead of taking people by surprise. So when banks decide to sell certain securities, they do it in very large numbers. Instead of surprising the markets by monetizing or liquidating a large portion of the portfolio, signal that in advance and let the market absorb that information so there's not a sort of a free fall in one day in the equities market because the central bank did that. The other thing is, as I mentioned, the reserves. They really focused on getting banks and insurance companies across the globe tightening up on their reserve accounts just to make sure that any rumbling in their economies will be backstopped by reserves at the bank level.
We'll have to see how many heed that warning. Thank you so much, Jonathan Morris, adjunct professor at Georgetown University.